But let's start with one reason we love the stock market and we're confident it will keep ticking higher.
Yeah, this is just a bit of a feel-good reminder for everyone. If you've just joined Equity Mates, we know a lot of people are joining the show for the first time. So we just wanted to take the top of the show, just, I guess, to remind people on how good the stock market is. We've done podcasts with on other shows, and the debate between, that feeling in Australia of property being far more secure and whatnot than the stock market. We've done some live shows where questions have come around, the long-term power of the stock market. So, yeah, we just want to take this moment to illustrate why we're confident that this strategy that we're in the stock market over a long period of time is absolutely the right one.
Yeah, because we all talk about the stats. We all say in between 1900 and 2022, the Australian stock market delivered 13.2% average annual return, including dividends. That's amazing. In the largest study of global stock market returns, Triumph of the Optimists, they looked at 100 years of stock market returns, and after inflation, the Aussie stock market was delivering like 7% average a year after inflation. The numbers are incredible. What we talk less about is why. And this is one of the big reasons why. Incentives matter. And as an investor in the overall stock market, millions of people are working for you.
Well, what does that actually mean? When you're investing, you're buying businesses. You're buying into the companies. You're an owner of the company. And at the crux of it, you have the whole company set up to make you as a shareholder money.
That's why they exist.
Yes.
To make shareholders money. Like that is their purpose for being.
It's in the Constitution.
So there's a couple of ways you can start this conversation. Let's start with the CEO. How much they get paid and whether they get a bonus is usually based on the share price. As a public company we're talking about here, which is how much money they make their shareholders. Or it might be based on growing the business, which ultimately grows wealth for shareholders. So that's the CEO. But then that incentive flows down into the organization. The CEO sets goals for their team members with employee bonuses and promotions based on how well the employees help the CEO reach their company goals. And for people listening who work for publicly listed companies, they probably know exactly what we're talking about because that's how you're personally incentivized in your job. But it doesn't stop there, because the third big player in a structure of a company is the board of directors, which is the group that oversees the company, ultimately hires and fires the CEO. They're elected by shareholders, by us, the owners of the company. And the fastest way to be not elected as a board of director is for the share price to go the wrong way.
That's it.
Yeah.
So in that example, you can see that as a shareholder and owner of a company, you have the board working for you. You've got the CEO working for you, and then you've subsequently got everyone in that company working towards the goals set by the executive.
Now, let's put some numbers to that theory. 2021 Harvard Business Review analysis looked at the highest paid executives for American publicly listed companies. It found that 82% of their compensation is variable, and then the remainder is their base salary. So in an example, round numbers, if a CEO has $1 million pay package, it would mean 180,000 of it is guaranteed, and then the remaining 820,000 is based on them reaching their company goals. The difference between earning 20% of their pay and 100% of their pay is based on how their ability to deliver for you as a shareholder.
That's why you see, classic examples even here, and think about Macquarie executives looking in that $30 or $40 million paychecks. Their base salaries are closer to $1 million, and the rest is just all in stock.
And let's be clear, we're not defending the absolute number of CEO pay. We're not saying that $30 or $40 million is justified.
Yes.
We're saying the fact that so much of it as a percentage is an incentive is good.
Yeah.
But that incentive would still apply if you chopped 2 zeros off the end of some of these paychecks, because it's the 80% being variable that matters, not the overall number. I want to be very clear about that. A couple of other reasons why the incentives structures set up for publicly listed companies is to make you money. The majority of CEO pay isn't in cash, it's in shares. Another Harvard Business Review found that On average, 59% of CEO pay is in company stock. Obviously, the more stock they're given and the longer the vesting period of that stock, the more aligned they are with you as shareholders because they are also shareholders. So I think the point to take away from this conversation is that incentives, when we're talking about public companies, are all orientated around making you as a shareholder more money. From the board of directors to the CEO down throughout an organization, they are all working hard to make you more money.
Yeah.
Apple has 160,000 employees. Microsoft has over 200,000. Walmart over 2 million.
It's crazy.
When you're a shareholder, you benefit from all of their hard work. And you can't say that about property.
You cannot say that about property at all. This is just one of the reasons I think that we are confident that the stock market will keep ticking up. We haven't even spoken about the fact that these companies are continuously innovating, driving change. Like, it's something that, yeah, when you compare the pair, but well, they're not even a pair, but between property and the stock market, you can understand why over a 120-year period it's pumping out 13% returns.
It makes me think of my favorite investing book, Margin of Safety by Seth Klarman. And he writes, there's a chapter in that book called Are You Investing or Are You Speculating?
Yeah.
And the point he makes is that there are some things that you'll buy where the only way you make money is if someone at some point in the future will pay more for that same thing. And then there are some things that you buy that will grow and change over time. And what you sell is fundamentally different to what you buy. And I think property, for how good of an investment it has been, and for the things that you can do around, like subdividing land or renovating and stuff like that, fundamentally, the block of land you buy is the block of land you sell, and you want someone to pay more for that same block of land. Whereas with investing, the company that you buy is fundamentally different to the company that you sell. Well, I'm sure that's going to inflame some tensions in the property lovers. We both are on the first rung of the property journey, and we're stoked that we get to be able to be there. So we're not anti-property, but what we are anti is the pro-property skew in the world.
Yeah.
Because stocks have benefits as well, and that's the case we're making.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful